Conventional wisdom says more information leads to better decisions. But behavioral finance experiments show the opposite. Beyond a threshold, accuracy plateaus or declines while confidence keeps climbing. This paradox explains why many investors underperform despite abundant data. In 1965, psychologist Stuart Oskamp ran a landmark experiment. He gave clinical psychologists a case study and asked them to diagnose the patient. The information came in 4 stages, each adding more data. After each stage, the psychologists made a diagnosis and rated their confidence. The results were striking: accuracy barely moved, but confidence soared. This is the first clear evidence that more information does not equal better decisions. Let's formalize the paradox. Define accuracy as a function of information. Initially, accuracy rises, but after a threshold, it flattens or even falls. Meanwhile, confidence keeps rising linearly. The gap between confidence and accuracy is the overconfidence gap. This gap drives costly behavior. The formula captures the divergence. As information increases, the gap widens. Now apply this to finance. Consider a retail investor who only looks at price charts and the P/E ratio. Compare them to an institutional analyst who reads 50 research reports daily and tracks 200 indicators. Who predicts next quarter's stock direction better? Surprisingly, studies suggest accuracy is similar. But the analyst's confidence is far higher. This overconfidence leads to more trades and higher costs. Overconfidence leads to overtrading. Barber and Odean's research quantifies this. They found that men trade 45% more than women, and this extra trading reduces annual returns by 1.4 percentage points. Why? Each trade incurs costs, commissions, spreads, and taxes. The formula shows that net return equals gross return minus trading costs. More trades mean more costs, eating into returns. Barber and Odean's data shows a clear pattern. Men trade 45% more often than women. This higher frequency leads to lower net returns. The chart compares trading frequency and annualized returns. The left bars show trading frequency, the right bars show returns. The message is clear: overtrading destroys value. Why does confidence grow with information? First, more data gives a false sense of control. Second, we remember our successes and forget our failures. Third, we confuse information with knowledge. Each new data point feels like progress, even when it is noise. This is the illusion of validity. The mind builds a story that fits the data, ignoring contradictions. In finance, information is a mix of signal and noise. The signal-to-noise ratio measures the useful information relative to the noise. As you add more data, the noise often grows faster than the signal. The ratio declines. This is why accuracy plateaus. You are adding more noise, not more signal. The formula shows that the ratio depends on the quality of your information filter. The real edge in finance is not information, it is a framework to filter noise and the discipline to ignore it. Knowing what to ignore is more important than knowing what to watch. This means having a clear investment thesis, predefined criteria, and a process to avoid reacting to every data point. It also means accepting uncertainty and avoiding the need to know everything. Let's summarize the key numbers from the evidence. Oskamp's study shows accuracy barely moved from 28% to 33%, while confidence jumped from 33% to 53%. Barber and Odean found men trade 45% more than women, costing 1.4 percentage points in annual returns. These numbers illustrate the cost of overconfidence. I've read 50 reports and tracked 200 indicators. I'm sure it's going up. I just look at the P/E and the trend. I think it's fairly valued. But you're missing so much information. Maybe. But I'm not paying for all that data with my returns. The information paradox is not just a curiosity, it is a practical challenge for every investor. In a world of endless data, the ability to filter noise and maintain discipline is the true differentiator. Remember, accuracy plateaus, confidence soars, and overtrading costs real money. The next time you feel the urge to gather more data, ask yourself, will this change my decision? If not, ignore it. Build a framework, stick to your process, and accept uncertainty. That is the edge. Your feedback helps us create better content. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.